Now, there's a lot of indicators out there, and they are what are called trend indicators. The favorite, so there's a lot of them you can learn, and it's a process to learn, obviously. But in this course, I'm going to teach you the indicator that I use. So I basically use the moving averages, right? So I want to keep things simple most of the time, because keeping things simple is going to help you a lot, right? So I'm gonna put 3 moving averages, right? And I'm gonna edit right here. The first moving average that I'm gonna put into the market is the 21 EMA. So you can use 9 as the smallest, but I'm gonna use the 21 EMA. Then the next one is gonna be the 50 EMA. So let me change the color for this one. Let's put this into red, right? Now we have the 21, the 50, and let's put in the 200 EMA. So this is the 200 EMA. So you can change. We are going to talk more about these indicators because I have a lesson dedicated to them. But then we can see that we have these 3 indicators right here, right? So now we have the 200 period EMA, we have the 50 period EMA. EMA means exponential moving average. And then we have the 21 EMA. So I want you to see something. When the market is moving strongly to the downside, what happens to these moving averages? First thing is they fan out, right? So they fan out, and you are going to see distance between them. So they fan out, right? They're going to leave distance between them, right? You want to see distance, right? First of all, we want to see gap, and you are going to see that also they are going to move in the same direction. And also you want the price to be below all of these 3 moving averages. That signals a strong trend. Let me show you one more example of this. So if we look into this market right here, you are also going to see that at this point, this is the same thing that happened, right? This market is in a strong uptrend. We can all agree, right? From this point right here to this point, this market was pushing to the upside. And what was happening between the indicators? Number 1, they were fanned out, which means there were distance between the moving averages. They also was moving to the same direction. And for the most part, prices was above all the 3 moving averages, signaling an uptrend. This is called an uptrend, right? And then the next time when we see this, we are going to be looking and seeing if what happens if they are not fanned out. Look right here. So now look what happened right here. These moving averages were not fanned out. They were, number 1, they were too close, right? So they were too close. Also, they were not moving in an upward direction or downward direction. So they were moving in a sideways direction. So this market is not trending either to the upside nor to the downside, right? So it's not trading to the upside, it's not trending to the downside. What this market is doing is, it is called ranging market. So this market is ranging. So we have 3 types of trends basically, right? We have, let me write right here so that I don't forget this, right? So we have 3 types of trends. We have number 1, an uptrend. And in uptrends, you are looking to buy because the market is pushing to the upside. Number 2, we have sideways. In sideways, the market is going to the sideways direction. It's not going up, it's not going to the to the downside. So I will say, as a trader, just stay away from this market. So there's strategies that you can use to trade sideways trends, but as a beginner, and I know when you're taking this course, you want to grasp mostly the basics. So, and you want to stick to the fundamentals so that you can master what is happening next, right? But then, if you are in the sideways, you need to stay away. There are also going to be strategies that you can use in sideways trends, but for now, just stay away. So the third one is downtrend. In the downtrend, we are looking to sell because the market is pushing to the downside. So I said, how do you understand where the market is going? Number one, you can use candlesticks, right? You can use candlesticks. When you see a huge green candlesticks or two consecutive green candlesticks, there's chances that the third candle is going to be also a green candlestick. So this market is trending for a short term. Now, here's the thing with understanding or with trading the market using candlesticks. What happens most of the time is these candlesticks are not going to run for always, right? So let me show you what I mean. So if you use candlesticks, for example, so if you look at this, you can see that we have two green candles right here. And these candlesticks have big bodies, especially this one. So the next candle that is going to come up is going to be likely a green candle. But don't expect this market to move maybe this way, maybe this size, or this big move right here. Why? Because the candlesticks, as you can see, the average of these candlesticks, there's no candlestick that is that is this big, right? So since there's no candle that is this big, so we cannot expect prices to move all the way up to this point. We want to either keep it short like this. This is the average candlestick. So if this is an uptrend, we are expecting that this uptrend can at least come to this zone right here, right? So in this case, maybe it happened, maybe it didn't, but you can see the candle was way bigger, but at least we got our target, was going to be our target at this point. We were obviously not going to place a trade right here, but we were going to jump to lower time frames, for example, the 1 minute time frame or the 5 minute time frame, right? But basically, if you want to use candlesticks to identify the trend, you want to keep your targets short. A candlestick is not the whole trend. A trend is created by a lot of candles, but a candlestick can show you the short-term movement of the price. So that's what I wanted you to understand. Now, back into using moving averages. Now, let me show you an example here of a market that is clearly in an uptrend and what you need to see, right? So, number one, what are we going to be looking at? We have our three indicators, the 21 EMA. So we have this one is the 21 EMA, this one is the 50, and this one is the 200. And firstly, we want to see gap between them. Do we have gap between these three moving averages? Of course, we have gap, right? So number one, we can see we have gap in this. Number two, we can see that they are moving up to the upside. So basically, if you look here, you can see that they are all moving in the same direction. So are they moving in the same direction? Yes, right? So at the same direction. And then for the third time, is the price above all the moving average for the most part? Yes, here the moving average. The price is above the moving average. So we're expecting prices to keep going to the upside. So what is so prices, right? Prices above the moving averages. That's the three concept, or that's the three rules that you want to see for you to identify if this market is in an uptrend. All right? So once you see these three things, it simply means your market is in an uptrend and you are going to be looking to buy. Now, how do you buy this market? How do you go ahead to place your buy trades here? Do you just buy anywhere? No, because obviously you don't want to buy at points like this, right? You don't want to buy at points like this. Don't want to buy here. You want to buy when the price is on a discount. So when you are trading, we said you want to buy low and sell high, right? So if the market is moving like this, you don't want to buy at the top. You want to wait for the pullback so that you can buy here and expect prices to push you up, right? So one of the biggest mistake that I see people making is they're going to go into the market, they see a huge trend like this, and then they're just buying because the market is in an uptrend. No, you need to be patient enough to wait for the market to reverse and come back into an area which is likely to be an area of value, or an area where the market is likely to push from, right? In this case, you can have this zone right here. Let's do this. No. So if in this case you can see the market have gotten into this zone here, and this is a place where we were likely going to buy, right? So why? Because we have this area and then we have the market meeting our trend criteria. But I'm not going to explain all this right now. Let's go into the next lesson, because I want you to be able to identify these zones, and then we'll create a strategy based on the trend, this area, and also what we have been learning, candlesticks, and what we have been learning in this lesson. So let's go into the next lesson and let's talk about how to identify these strong areas of value, like this one right here, where you could have placed a buy trade. Again here, if you could buy here, right? So let's say you were going to place a buy trade right here where the market is at, right? And put your take profit above. If the market goes up, you make profits because you are buying, right? And let's see what happens here. So the market keep pushing to the lower side, right? Pushing to the lower side, and now we are in profit loss, and let's see what happens. Now we are in loss, market goes back to profit. Now it's going up. You can see the market is moving in this range. So right, so now at this point we are not panicking, we are expecting prices to push to the upside, but then it's gonna take some time. Let's see what happens, right? You can now see the market is now trying to push to the upside, right? Here you can see market pushing to the upside. In this case, you could have already been in profit, right? You can see the market now pushed it to your take profit. Why? Because you are trading based on a strong zone here. This is a strong zone. This is what is called an area of value. Let's move into the next lesson and let's talk about this in depth, and hopefully you can come up with something very important. Let's do that right now.